topic on everybody's mind and doesn't really need much of an introduction is the inflation bear attacking our bull market. We are all feeling the pinch right now. Prices on everything has gone up. Clothing, food, gasoline prices, cars, electronics, travel, generally all increasing at a pace we haven't seen since the 80s. You really have to go back all the way to 1983 to see what we're seeing now as far as inflationary levels. So how did we get here, and what's causing all of this inflation? There are a number of factors, and I won't spend too much time on this, but they're really categorized under two sides, either a demand side issue or supply side issue. On the supply side, obviously COVID was a wrecking ball on our fragile global supply chains, causing disruptions that led to industries going into disarray, port closures, labor shortages, lack of shipping containers. That actually pushed the global freight rate to $10,400 in September of 2021, up from just $2,644 a container a year earlier. You had factory closures in China, disrupting manufacturing processes, semiconductors especially being hard hit, leading to things like vehicle shortages. Just as a side note, the semiconductor takes up to 27 weeks lead time, meaning that's how long it takes from a chip from order to delivery. So if factories shut down for even a week, the backlog could become unmanageable. And of course, this drove up prices in things like your computers, your vehicles, all other electronics. We have geopolitical tensions, the Ukrainian conflict, Brent crude oil going to $120 a barrel in March, fertilizer prices shooting up as Russia is a major exporter of the world's potash. And then we had accelerated retirements post-pandemic, shortage of skilled labor, stopping immigration and migration during COVID. Costs of labor all went up, and now there's more job openings than there are unemployed people to fill them. On the demand side, we had generous fiscal support during COVID, driving consumer spending on discretionary goods as household disposable incomes increased. Higher wages in the labor market meant higher spending habits and demand for goods. So, we've also seen migration and urbanization driving up shelter costs in key metropolitan areas. Low interest rates in response to COVID, increasing household borrowing and debt levels. And this was demand for goods already facing upward pressures thanks to those supply chain issues. So you got too much money chasing too few goods, and naturally drives the prices up to these levels we're seeing today. Okay, so that's a quick primer on inflation. Very quick primer. So now what? Well, this leads to here. Stocks and bonds down year to date. Not a really common occurrence to see them moving in tandem. The red line there, call it pink maybe, is the bond market. 14.16% drop in the bond market year to date. 21% drop in the largest 500 companies in North America on the S&P 500. That's a very big pullback. Growth companies hit even harder. The purple line there is the NASDAQ. When I last printed this as of September 23rd, it was down 28%. So there's not much of a way to hide in your average balanced portfolio, given the stock market was down and the bond market was down, given these surging bond yield rates. So why is inflation so bad for stocks? First of all, it kills your profit margins. So some firms can pass the costs off, like a grocery operator, for example, but eventually there's a limit on how much the consumer can take. So labor being a key input in production, and wage prices rise, margins of companies will erode. When inflation rises, then central banks are forced to raise the interest rates to protect price stability. So this slows the whole economic engine down and the growth outlook of many firms. Because the stock market, which is really just an amalgamation of all the prices and all these companies that make up an economy, it's a leading indicator of the economy. So these prices that we are willing to pay for these companies adjust to what? To decreasing expectations of their future growth. So the other thing is that stocks are prices we place on the values of these companies will look less attractive in comparison to bonds. So 12-month US government bond yields over 4%. This is attractive as it's essentially a risk-free rate. The US government's not going to default in 12 months compared to, say, the largest 500 companies in North America whose stock prices are down 20% this year. Higher interest rates also mean higher discounting rates that we place on the future value of those cash flows. So this is how we come up with a value for a company. We look at an expectation of its future cash flows and we discount those based on a risk-free rate. And then we come up with a price we're willing to pay today for the expectation of those future cash flows. So if those cash flows are going down because we expect lower margins for these companies and a higher discounting rate for those cash flows, we're going to reprice stocks and other risk assets downward. So are we going to have a recession? Well, we could be in a recession right now. One of the ways to avoid a recession is to just simply change the definition, which central bankers are sometimes apt to do. But if you see 2 negative consecutive quarters of GDP growth, you technically used to be in a recessionary environment. So definitely we are seeing a slowdown in global GDP. Our base case is, we are either in a recession or there's a very high likelihood that we will be in a recession in the next 12 months. Hopefully a soft one, given the underlying strength of the economy. Central banks have to ensure price stability before inflation becomes entrenched. That's why they have to increase rates. If the central banks take their foot off the brakes too soon, even if we see sectors like manufacturing going into further contraction, you could see what we saw in the 70s with a wage price spiral. Once wage prices become entrenched, it's very difficult to remove them. And that inflation then becomes more pervasive and harder to manage. The laughing issue here was that it was transitory. We're clearly seeing that that's not really the case. So some silver linings, we're starting to see some of these supply chain issues resolve as COVID cases come down. China's easing up on some of its zero COVID policies, not to 100%. We're still seeing, major Chinese cities locked down. Canadian CPI might have peaked. Border restrictions have been removed recently. The removal of the Arrive Can app will likely see more immigration to Canada, filling some of those job vacancies and potentially taking pressure off wage inflation. Overseas supply chains are being repatriated closer to home. Shipping rates are definitely well off their highs, and firms are a little optimistic about the road ahead, and they're continuing to hire if they can find people to find the jobs. The U.S. Michigan Consumer Sentiment Index was actually off its June lows. So the consumer was feeling depressed and is a little bit less depressed at this point. Canadian banking, resilient, even in the face of a housing contraction, thanks to proactive mortgage stress tests. So what did we do? Well, when things are volatile, that we will get more active with your portfolios. And we have been extremely active this year in all of our managed portfolios for our clients. We've rebalanced all of our larger portfolios 3 times, as well as making individual security changes within the portfolios. This active management protected our clients, from the full effects of the recent market volatility. For example, recently we took profits from a company we like, QSR. You might not know QSR, but you definitely know part of QSR, which is Tim Hortons. And we bought another, what we think is more value name, Medtronic, a global leader in medical services devices, which we believe will further shelter our portfolios from volatility. So why are we being more active in a year that's this volatile? What are we actually doing behind the scenes here to manage your money? So we have a set of rules, and these are rebalancing criteria. What they'll do is that takes the emotion out of the management of your portfolio. When you have a crisis, if you have a set of rules or processes that you follow, then it makes it a lot easier to manage the crisis because you can fall back upon those rules and processes. So that rules-based approach to our rebalancing and our asset allocation essentially takes the guesswork out of managing your money. So in 2022, we had 3 instances where it required full rebalancing of all of our portfolios because the downside threshold for stock markets based on the last time we rebalanced had been breached. So markets went down. So instead of taking a haphazard approach to when we purchase more stocks, it means as equities sell off in reaction to developments in interest rates, we will take profits or positions from other portions, the other eggs in your basket, and add more to our equity sleeve. This is very effective, as our models have essentially taken far less risk than the equity markets in general. For example, our pension model is down 10.9% as of last time, September 20th, we ran the numbers, compared to the S&P 500, which was down 21%. So roughly half the risk of the biggest 500 companies in North America. If you look at passive ETFs or index funds like VBAL, it was down over 14%. So a passive approach has not protected your money. Our active approach to money management, that rebalancing process with our tilt towards better value versus growth companies, has worked out extremely well. So, recession, yes or no? Well, if CPI remains elevated, that's going to cause us to definitely remain in a recession. We'll see labor markets remaining tight. You'll see wage pressures persisting, manufacturing, housing contracting further. And we'll just continue our process. We will rebalance our models, removing or reducing our growth positions and adding to what we'd call more of a value tilt, companies paying dividends with good cash flows. If CPI does start to trend downwards and the labor market slack increases, wages will hopefully decelerate or at least level off. Supply chains will reopen and we can rebalance our models again, but adding to some of the growth positions like our platinum equity pool. So what that really means is if you've got 65% stocks in the portfolio right now and the stock market drops and you end up with 55% stocks and we get that significant of a pullback from this point, we will rebalance your portfolio back to its target asset allocation for you. So this is being done automatically behind the scenes with an active approach and a process to the management of your portfolio. So just like to reiterate that we're here. We're active, we're very busy during these times, but please do reach out. If you want further clarification on anything I've talked about today, please reach out directly to your lead advisor. The portfolio management team is always here to answer questions via phone or email, and we look forward to catching up with you soon.